We were taught that saving money is the safest path to financial security. But in a world shaped by inflation, debt, and rapid change, could saving actually be making you poorer? Most people believe that putting money in the bank is the safest financial decision they can make. But what if that belief itself is part of a much bigger illusion? We grow up hearing the same advice from our parents and grandparents. Study hard. Get a stable job. Save money for the future. It sounds responsible. It sounds moral. It sounds safe. But there is one critical problem. That advice was built for a completely different economic system, one that no longer exists. In the 20th century, money was still connected to something real. Today, in the 21st century, following the same advice without understanding the system can quietly lead to long-term financial stagnation. Have you ever wondered why previous generations could raise large families and buy land with ordinary jobs, while today many people work longer hours, spend less, save more, and still feel that owning a home is slipping further away? Is it because people have become less disciplined? Not necessarily. The deeper reason is that the rules of the financial game have changed, but most people are still playing by the old ones. For many people, saving means holding cash. But in a modern fiat economy, cash is not truly a store of value. It is a financial instrument whose purchasing power is constantly being diluted over time. When you hold money without deploying it, it can feel like holding melting ice in the desert. The tighter you hold it, the faster it disappears. In this video, we are not going to talk about small lifestyle hacks like skipping coffee or cooking at home. Instead, we are going to explore the macroeconomic forces that shape your financial reality, often without you even noticing. Take out your wallet for a moment. Look at the highest denomination note you have. Examine the patterns, the numbers, the symbols of authority printed on it. Now ask yourself a question that most people never stop to consider. Is this truly money? Or is it simply a widely accepted promise? For thousands of years, money had to meet strict requirements. It needed to be durable, divisible, portable, and most importantly, capable of storing value across time. Gold and silver fulfilled these roles remarkably well. An ounce of gold in ancient Rome could buy quality clothing and goods. And today, an ounce of gold still holds comparable purchasing power. That is what it means to store value. It preserves human effort across space and time. But modern paper currencies, dollars, euros, or any national currency, possess almost every feature of money except the most important one. They gradually lose purchasing power. Economists call this system fiat currency. The word fiat comes from Latin, meaning let it be done. In other words, currency has value not because it is scarce, but because institutions declare that it has value. This difference may sound subtle, but it has enormous consequences. One of the most important turning points in financial history happened on August 15, 1971, when U.S. President Richard Nixon announced the suspension of the dollar's convertibility into gold. Before that moment, every new dollar created was constrained by physical reserves. After that moment, the global financial system entered an era where money could be expanded much more freely. Since then, inflation, asset bubbles, and widening wealth gaps have become recurring features of modern economies. To understand how this works, imagine an auction where everyone is given the same number of tokens. Prices remain stable. But suddenly, organizers secretly give thousands of extra tokens to a small group sitting in the front rows. What happens next? They begin buying everything. Prices rise rapidly. Those sitting in the back, ordinary workers and savers find themselves unable to afford what they previously could. This mechanism resembles what economists call the Cantillon effect. New money tends to reach financial institutions and large investors first. They use it to acquire real assets, property, equities, commodities, pushing prices higher. By the time wage earners feel any benefit, living costs have already increased. So when people save purely in cash, they may unknowingly be accumulating something whose supply can expand far faster than their ability to earn it. In that sense, inflation can act like a hidden tax, gradually transferring purchasing power from savers to asset holders. Over time, this dynamic can also shape behavior. When money loses value quickly, societies tend to prioritize short-term consumption and speculation over long-term planning. And this shift affects not only financial outcomes, but also culture, psychology, and life decisions. If housing prices double every few years, why would anyone patiently wait decades just to afford a home? If speculation can generate faster returns than productive work, why would long-term value creation still feel rewarding? Modern monetary systems can unintentionally reshape incentives. They can push economies toward short-term gains rather than sustainable growth. People who follow traditional saving mindsets may feel increasingly frustrated. They cut expenses. They delay gratification. They watch their bank balances grow slowly. Yet at the same time, the broader financial environment may be quietly reducing the real value of their effort. This creates a psychological experience similar to running on a treadmill. You move faster and faster, but remain in the same place. Many people interpret this as personal failure. They blame themselves, their employers, their circumstances. But often, the deeper forces are systemic. Throughout history, major monetary regimes have eventually transformed or collapsed, from ancient Rome to more recent examples like Weimar Germany or Zimbabwe. The lesson is not that money itself is meaningless, but that trust, policy decisions, and institutional stability play enormous roles in determining its long-term value. We may be living through another large monetary transition, one characterized by rising global debt and increasingly complex financial interventions. In such an environment, holding large amounts of idle cash can feel uncomfortable. Wealthy investors rarely treat cash as a long-term destination. Instead, they treat it as a temporary vehicle, a way to move from labor into assets that may better resist inflation. These assets can include businesses, equities, real estate, commodities, or emerging digital assets. The first difficult realization for many people is that currency itself is not the ultimate goal. It is a measuring tool, and like any measuring tool, its reliability can change. Once this idea becomes clear, financial strategy begins to shift. The objective is no longer to accumulate pieces of paper, but to build access to real resources, skills, networks, and productive assets. This perspective becomes even more important when we look closely at how modern banking systems actually operate. Think about how you feel when entering a bank branch: the polished floors, the calm atmosphere, the reassuring messaging about safety and stability. All of this builds trust, and trust is essential for financial systems to function. But beneath that reassuring surface lies a much more dynamic reality. Banks do not simply store money in vaults. They transform deposits into loans and investments. In other words, they intermediate risk. When you deposit funds, you are effectively providing capital that can be used to support broader economic activity. This process is known as fractional reserve banking. For example, if a bank holds only a portion of deposits as reserves, it can lend the rest to borrowers. Those borrowers spend the money, which may then be redeposited into other banks. Through repeated cycles, this mechanism expands the overall supply of credit in the economy. From one perspective, this supports growth and investment. From another perspective, it can also contribute to inflationary pressures and asset price increases. Meanwhile, depositors often receive modest nominal interest, while financial institutions may earn significantly higher returns from lending and investment activities. To understand the true outcome, we must consider real interest rates. If savings earn 6% annually, but living costs rise by 10%, the real purchasing power of those savings is declining. This creates a subtle paradox. Savers may feel financially responsible, yet still experience a gradual erosion of economic security. Over time, this dynamic can also influence behavior. People who focus exclusively on preserving capital may avoid investing in education, entrepreneurship, or calculated risks that could transform their future. In contrast, more sophisticated investors often do the opposite. They borrow strategically, using low-cost credit to acquire assets that may appreciate over time. As inflation reduces the real burden of their debt, the value of their holdings can increase. In this way, the same financial system can produce very different outcomes depending on how individuals understand and navigate it. Consider this simple cycle. You work to earn money. You deposit it into a bank. That capital is then used to finance business expansion, investment, or consumption elsewhere in the economy. In many ways, modern financial systems are designed to pool small amounts of individual savings into large streams of capital that can support large-scale growth. From one perspective, this process is efficient and necessary. From another perspective, it can feel as if individual savers have very little control over how their money shapes the world. Over time, people may begin to trade long-term financial autonomy for short-term convenience and perceived safety. They see impressive financial institutions, towering buildings, and sophisticated systems, and interpret them as symbols of stability and national progress. But behind these structures lies a simple truth. Money rarely stays still. Financial institutions themselves move capital continuously into assets, loans, and opportunities that generate returns. If the institutions that create financial products avoid holding idle cash, why do individuals often do the opposite? The answer is rarely technical. It is psychological. At some point, the discussion about saving stops being about economics and becomes about human behavior. Why do millions of people continue to prioritize saving even when they understand that inflation exists? Why does the absence of a financial buffer create such intense anxiety? To understand this, we need to look much deeper into the evolutionary wiring of the human mind. For most of human history, survival depended on scarcity. Food was limited. Winters were harsh. Resources were uncertain. Failing to store enough could mean death. As a result, the human brain developed powerful survival mechanisms, including what psychologists now call the scarcity mindset and loss aversion. These mechanisms prioritize immediate safety over uncertain future gains. They encourage holding on to what we already have rather than risking it for potential growth. In ancient environments, this strategy was rational, but in modern economies, characterized by technological progress, financial innovation, and expanding monetary supply, the same instinct can sometimes become counterproductive. People operating under a scarcity mindset often focus intensely on cutting costs rather than expanding opportunities. They may spend hours searching for small discounts. They may feel guilt over minor purchases. They may optimize for short-term savings while overlooking long-term value creation. In doing so, they unknowingly sacrifice mental bandwidth, the cognitive space needed to recognize larger opportunities. This creates one of the most subtle financial traps. You become so focused on protecting small amounts of money that you miss the chance to build significant wealth. This brings us to one of the most important concepts in economics: opportunity cost. When you keep capital in low-yield environments purely for safety, the true cost is not the money you spend. It is the growth that never happens. A sum of money that earns modest interest may feel secure, but in the hands of someone willing to invest, learn, or innovate, the same capital could potentially transform into something far more valuable. Opportunity cost is invisible. It does not appear on bank statements. No institution sends you a notification showing what your financial life could have been. Yet over time, it shapes outcomes in profound ways. Entire versions of your future, more independent, more creative, more prosperous, may never materialize simply because fear prevented you from taking calculated risks. In finance, there is a principle that appears again and again. Returns are often a reward for uncertainty. This does not mean reckless speculation. It means recognizing that growth requires engagement with risk. And this realization sets the stage for the next layer of the story. Because once we understand the psychology of fear, we can begin to explore what a more intelligent relationship with money might actually look like. People operating under a scarcity mindset often define risk in a very narrow way. For them, risk means seeing their bank balance temporarily decline. They may prefer the quiet certainty of losing purchasing power over time, rather than facing short-term market volatility that could potentially lead to long-term growth. In a rapidly changing financial environment, remaining completely passive can itself become a significant risk. When monetary expansion accelerates, standing still financially may feel safe, but in reality, it can mean slowly falling behind. Fear can turn caution into paralysis. It can encourage individuals to focus only on preservation rather than participation. Yet one of the most profound consequences of this mindset is not just financial. It is the reluctance to invest in the most valuable asset of all, oneself. When money becomes something to be protected at all costs, people may hesitate to spend on education, health, experiences, or relationships that could expand their capabilities. A course may seem expensive. A book may feel unnecessary. A mentorship conversation may appear like a luxury. But these are often seeds, and seeds that are never planted cannot grow into future harvests. Over time, people who consistently prioritize safety may accumulate resources, but fail to accumulate momentum. In contrast, individuals with an abundance-oriented mindset tend to view money differently. They see it less as an endpoint and more as energy, something that must circulate, transform, and create movement. They are not careless with spending. They are selective. They seek to deploy capital into opportunities that can generate skills, networks, or productive assets. Another subtle trap emerges at the level of identity. Many people take pride in being disciplined savers. Families and societies often reinforce this behavior with praise and validation. Over time, saving becomes more than a financial habit. It becomes part of how people define themselves. Changing strategy then requires more than learning new information. It requires letting go of an old identity. This can be psychologically uncomfortable. It may feel like admitting that previous decisions were incomplete or based on outdated assumptions. As a result, some individuals continue repeating familiar patterns, not because they are optimal, but because they feel morally correct. They may view investors or entrepreneurs with skepticism, interpreting calculated risk-taking as recklessness or luck. Meanwhile, their own strategy of extreme caution quietly limits their potential. Another important realization is that financial anxiety does not automatically disappear as savings increase. For those deeply influenced by scarcity thinking, larger balances can sometimes amplify fear rather than reduce it. Instead of feeling freer, they may feel more responsible for protecting what they have accumulated. In this way, money begins to reverse roles. Rather than serving the individual begins serving the money. Escaping this dynamic requires a shift in perspective. Modern wealth is rarely built by storing resources in isolation. It is often created through flow, through movement, exchange, and participation in productive systems. Savings accounts can provide stability and liquidity, but long-term wealth tends to emerge from cash flow, from assets and activities that continuously generate value. To activate this flow, individuals must gradually develop comfort with uncertainty. This does not mean reckless behavior. It means learning how to allocate capital intelligently. In many cases, the greatest risk is not experiencing financial loss. It is never engaging deeply enough with opportunity to grow. This realization naturally leads to a deeper question. If true wealth is not defined simply by how much cash someone holds, then what actually qualifies as an asset? Popular culture often portrays billionaires as individuals surrounded by endless piles of money. But in reality, the balance sheets of the world's wealthiest people are dominated not by cash, but by ownership. Ownership of companies, ownership of productive assets, ownership of systems that generate future income. Cash, in this framework, is rarely a final destination. It is a temporary medium, a way to transition between forms of value. Different groups of people tend to interact with money in different ways. Some prioritize immediate consumption. They exchange income for short-term satisfaction, often without building long-term financial foundations. Others focus primarily on accumulation, sometimes confusing liabilities or lifestyle upgrades with genuine wealth creation. And a smaller group learns to distinguish between assets that generate cash flow and possessions that primarily consume it. Understanding this distinction may be one of the most important financial insights a person can develop. At some point, true financial awareness requires stepping back and observing your personal balance sheet from the perspective of an investor. Not every possession is an asset, and not every liability looks like a burden at first glance. A useful principle is simple. Assets tend to put money into your pocket over time. Liabilities tend to take money out. A beautiful home may provide comfort and emotional value, but if it continuously demands mortgage payments, maintenance costs, taxes, and utilities, its financial role becomes more complex. Likewise, luxury purchases can deliver short-term satisfaction while gradually reducing long-term financial flexibility. Many people spend decades working hard to maintain lifestyles that feel like progress, yet quietly limit their freedom. By contrast, individuals focused on long-term wealth creation often prioritize ownership of productive systems. They may hold equity in businesses, income-generating real estate, intellectual property, or financial instruments designed to participate in economic growth. Their mindset is not centered on hoarding currency. It is centered on conversion, transforming temporary income into enduring sources of value. In this framework, cash is not useless. It is essential for liquidity and opportunity. But it is rarely the final destination. It is a bridge, a transition point between effort and ownership. This perspective also explains why leverage, when used responsibly, can play a powerful role in wealth building. Debt can be dangerous when used to fund consumption, but when aligned with productive assets, it can amplify growth. Borrowing today to acquire assets that generate future income has been a recurring strategy across modern financial history. At the same time, true wealth extends beyond physical investments. Networks, reputation, specialized knowledge, and access to information can compound in ways that traditional savings cannot. These intangible assets often determine who sees opportunities first and who benefits most from structural change. Another important distinction emerges between ownership and control. Some individuals seek to personally possess everything they value. Others focus on building structures that allow them to influence outcomes without concentrating risk. The deeper lesson is not about copying the strategies of billionaires. It is about understanding that wealth is dynamic. It is not a static number in a bank account. It is a system of relationships between capital, time, risk, and human capability. So take a moment to reflect. Look honestly at what you are building. Are you primarily accumulating currency, or are you gradually constructing assets that can support your future? Are your financial decisions driven by fear or by informed participation in the world around you? Real financial transformation rarely happens overnight. Begins with awareness, then learning, then small, intentional shifts in behavior. Over time, these shifts can compound into entirely different life trajectories. In an era defined by rapid technological change and evolving economic systems, those who understand how to create and manage real assets gain a powerful advantage. Not because they avoid uncertainty, but because they learn to work with it. And perhaps the most important realization is this: money should ultimately serve your life, not the other way around.